And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Sean Barrette, partner at L Squared Capital, who has about 550 million in assets under management. Sean, thank you very much for being on the show.
Thanks for having me, Adam. It's a pleasure to be here.
So, Sean, can you begin by telling us your story and how you got started in the business?
Sure. So I started my career as a public account and then moved into investment banking after several years of doing that. I joined a firm called Chicago Growth Partners, based in Chicago. Go figure. Worked there for a number of years, and in 2014 we started L Squared Capital Partners, which is based here in Newport Beach, California. We continue to have an office in Chicago.
Oh, very nice. So, you started off as an accountant. What led you to go into stocks or Wall Street or move in that direction? Oh, very nice. And then, I guess, can you tell us a little about your investment strategy?
Sure. So we're growth investors. So we're private equity, and we focus on growth companies. A big tenet of our investment strategy is revenue quality. So we invest in companies that have either contracted SaaS revenue, highly repeating revenue, that they're very important to their customers. They're also growing as they are today. Many of the businesses are founder-owned and haven't taken institutional capital up until this point in time. And we believe that based upon our experience and toolkit that we bring to the table, we can help them grow quicker and faster. So we take majority positions in growing companies based in North America in the tech-enabled services and software sectors, education technology, and industrial tech and services. After we invest in a company, we work with management to set up a 5-year strategy that we can execute on together. We oftentimes are building a team, investing in the product and service portfolio, implementing new systems, and helping the company complete its first M&A transaction as an acquirer. And one of the ways we made our company very successful over time is to be very aggressive on M&A.
I love it. So, help educate the audience a little bit. As a private equity investor, what is the big picture role as far as going in, seeing value, seeing undervalued companies or assets, and then how you guys add value and what you do exactly for the layman to understand?
Sure. So we're focusing on lower middle market companies, which we define as businesses that are cash flow positive and have up to 25 million in EBITDA. Oftentimes, as I mentioned, they're not those companies. What we're looking for are businesses that are emerging growth markets, meaning there are secular trends that are long in the tooth that are just beginning. Meaning the overall market is growing at above average rate. So if the U.S. economy grows 2 to 3% per year, we're looking for markets that are growing upper single digits, if not double digits. We're also looking for businesses that have a tech enablement component. The technology enables the company brings to the table, either changing the labor ratio or it's making it cheaper to adopt or overcoming objections from customers. The next thing we're looking for is that revenue model. We're looking for businesses that have a strong revenue model and are highly embedded with their customers. They may still cycle, but they cycle less than the overall economy will be in a recessionary period. And then lastly, we look for high margin businesses. So that's margins are a proxy of how much intellectual property comes to the or know-how comes the company brings to the table and how important that solution is to the customer.
So, just to recap, so you're looking at companies in low to middle market, 25 million EBITDA, so in earnings right around that before taxes and all that fun stuff, depreciation, etc. And then you guys want companies that are growing, or the industries that you invest in that are growing faster than the overall economy. And then you want to find a company that is founder based, or preferably, and then you guys would step in. After you step in and make the majority investment, so you pay the founder, let's say he's got $1 in earnings, you pay him, you value the company at 2 times earnings, so you give him the value of the company with $2. So you want a 51% stake, so you give him $1 and change to own at least 51% of the company, or whatever you agree on, 70-30, 60-40, whatever it is. Once you're in control, how does that process work? And where is the value being created from a private equity standpoint in general, or for you guys specifically, and to the founders? In other words, what's in it for the founder to make a deal with private equity, and where does that value add come from? For those that don't know. That's awesome. So, yeah, sorry, go ahead. So that's a fantastic way of explaining it. Now, the founder, meaning he has wealth, but he's not capital, or she has wealth and she's not doesn't have a lot of liquidity. That just means as far as liquid cash, most of their money tends to be invested in the business, and then they're not as liquid. So you guys come in, you give them. They tend to be later stage people, or people have been working on their business for years, and they want liquidity. And then most, if I understand you properly, most small businesses or even medium-sized businesses that are founder run tend to be run without a formal corporate structure. They don't have a board, they don't have proper rules and regs or just procedures in place. So you guys come in and institutionalize it, if you will. And that's where the value gets created as far as step one. Is that correct? I love it. So next question I have for you is, how do you handle risk in the private equity space, and I guess investing in non-liquid assets, if you will? And what mistakes do you see people make with respect to risk management in your business?
The obvious way people get into trouble is they take too much leverage. They underestimate the cyclicality of the industry or where you are in a cycle, and they may just take too much debt to the point where the company can't service it if things go the wrong way. The other way, the other couple of obvious areas of customer concentration, you can't be over-indexed to one customer. An example of that would be e-commerce businesses that have too much exposure to Amazon. That's probably something that's related to your listeners. And obviously, Amazon has a lot of power, but they also have a significant customer for a lot of businesses. And never go away. That used to be the Walmart issue. And then lastly, just exposure to foreign countries. So, in the different currencies, you have to take that into account. Those do move around over time. You need to have a proper risk management strategy around hedging your currency risk in the short to medium term.
I love it. That makes perfect sense. And then what about actual, I guess, risk with the businesses? Do you ever have a situation where you find things that you didn't anticipate after you make a deal? And if so, how do you handle those?
Yeah, you go through a significant due diligence process. But, 3 to 6 months after you own the business, you really know what you have. You're always things that come out of the woodwork. You always learn new things that you wish you had known. And that's anybody who knows the difference.
It's very true.
There isn't any
Makes perfect sense. So, Sean, what are some timeless investing lessons you'd like to share with the audience?
I think patience is underrated asset for any investor. Especially in private equity, you're in a position where you have to pull the trigger today. You have to access some time to do your homework and do your diligence and get comfortable with the risks associated with any decision and really come up with a game plan or your mitigants around those. And I think the other is, anytime somebody tells you that this time is different or the metrics that are fundamental to any investment, meaning revenue growth and cash flow, are important to your decision, or they're trying to get you to do something that doesn't make sense. I think being fundamental, grounded in fundamentals over the long run is important. You can make decisions as a management team and a board that affect the profitability of the company in the short run, but over the long run, businesses need to be profitable, and great businesses show strong operating leverage over time. And I think the best businesses are the ones that can self-finance their growth. I've seen those ones that are real special businesses, they can grow at a rate at the same time they're able to do it so profitably and not have to rely on seeking outside capital to fund that. Obviously, every business needs some little funding early on, but once it's up and running, it should scale and take that self-finance.
Do you have any examples of a business that would fit into that category?
Sure. A business called Health Channels that we invested in back in 2014. Great business run by the founders. We helped them build their team. They had a great business model where they were able to grow 50% plus top line, but at the same time doing a high teen EBITDA margin, positive cash flow. And they just had a culture of internally of being maniacal about pitching pennies and not spending money on unproductive overhead and focusing on the areas of business that drop off, and because of that, they were able to maintain that high growth rate over time and build a very substantial business. Approaching 100 million under the ownership of another fund.
Wow, well done. So, what are some mistakes, timeless or classic mistakes you see people make that you haven't already mentioned when they come to make investments, whether it be founders trying to grow or other outside people, whether it's private equity or just other family office, whatever, angel investors trying to buy businesses that you see people just miss, or blind spots, if you will?
I think groupthink takes over, and sometimes I see firms make decisions that almost ignore the obvious risk in the business because they get comfortable with it through groupthink. I think for us and elsewhere, we avoid that as a partner on the deal. There's a high level of ownership by that person around everything, and others in the investment committee. The decision, the partner on that deal is ultimately responsible for making sure every single risk is thoroughly diligent and they're representing it properly to the investment committee. Another thing that I see is just, we talked about leverage, but looking at certain industries, I think the wrong way. Not respecting some of the cyclical nature of certain industries, or really thinking about balance sheet from a risk perspective is one of the things that come in and high assumptions on. And I think the last piece is just patience. You see a lot of businesses now that are private equity owned where fundraising cycles and some ways dictate a lot of decisions at the company level, which leads to decisions that aren't necessarily in the interest of the company. For example, getting a recaps early in the deal life cycle that over-levers the business that return capital to shareholders. It may look good for fundraising and it may be necessary for fund life issues, but it's a bad thing for the company itself. So one of the things we solved for that, one of the ways we solved for that here at Elsewhere is we created an evergreen fund structure to take away those artificial timelines from how we invest in our companies and the decisions we make.
That's a really important point. Can you just elaborate a little bit? So typically, most private equity shops have a lockup period of 5 years, 7 years, 10 years, somewhere where there's an actual deadline in the fund. So the fund's going to expire at a certain time and the businesses will be sold or be rolled over to another fund. So can you just explain a little bit how you solve that problem? Because I've seen that happen with other people.
Yeah, the typical fund life is 10-year life, maybe 12. The investment period is 5 or 6 years.
Oh, that's fantastic.
So the idea is that the decision making is put back into the hands of the board of directors at each individual portfolio company.
Without some arbitrary time, tick tock, just because the fund was set up at some time that has nothing to do with the business.
Yeah.
Yeah, that makes perfect sense. So, you earlier, before I ask you the next question, I want to go back to a point you addressed earlier. You said you look for companies that have strong revenue growth. Do you look for strong earnings growth as well, or do you just look at top line and say, hey, this if this company is growing the revenues, I can go in there and work my magic, so to speak, meaning cut costs or help in efficiencies or whatever the case may be, and grow earnings that way? Do you care about earnings growth as well, or is it just revenue growth?
We do care about earnings growth, but we care less about correlation. We care more so later on. So we want businesses that ultimately can show positive operating leverage. But early on in businesses like you make your own decisions about profitability oftentimes based upon how much you want to put in, how much investment you want to put in the business in terms of sales and marketing and R&D.
Right.
So our strategy is to invest heavily in both of those early on, build the team in the right way, set up a product roadmap or service roadmap in the right way, which is where it aligns with the strategy that we agreed on with the management team at the board level. So, we will oftentimes in our deals have revenue grow rapidly early on, but EBITDA will remain flat to slightly down because we are making those investments. That does make us a little bit different than the average share in the private equity community, which does not see revenue and earnings grow almost in parallel.
Well, hence my question. That's why it jumped out at me when you were speaking. So I wanted to get clarification on that. So thank you for clarifying. Next question for you, Sean. What is the best piece of advice you can share with the audience?
If you're going to be in the private equity world, the best thing you can do is be patient for businesses that are durable over time. Sometimes the businesses haven't been around long enough to back test the data as it looks for the 2008, 2009 recession or further back. The businesses that are led by, ultimately we're trying to create businesses that are in good markets led by excellent managers that have excellent revenue models, business models, and have good moats around them so we can defend the margin profile of business. They don't have to be hyper growth businesses, but if you do have that equation, you will grow at above average rate. And if you manage it well, you'll have good earnings profile, good operating leverage. So for us, that's the secret to success. And those businesses are, in our experience, end up being worth a lot of money down the road as they gain scale.
That's fantastic. And then I guess my final question is with respect to multiples that you pay for earnings, how do you value a company? Because I know a lot of the listeners, they like, values is subjective, largely subjective. It's not really objective for most people. It's like beauty. Beauty's in the eye of the beholder. I like to say values in the eye of the beholder as well. How do you value companies? Do you look at a multiple on earnings? I know you focus more on revenue, but can you speak a little bit to how, I guess, how a good way to value companies is?
Yeah, so look at many different methodologies. Valuation is an art as much as it is a science. We look at precedent, private transactions that traded and kind of find a valuation around those. And usually use our network to find that information. We look at public comparables, where the public comps trade. Obviously, those businesses are substantially larger, so it's not as direct. It's not directly applicable, but it gives you some information. We look at discounted cash flow analysis, taking into consideration the investments that we would need to make into the business to drive the outcome we desire. And I think the biggest thing that we run into, granted, obviously multiples are very high, but when we have a situation where we're approaching a smaller business in the middle market that's not around a major CD transaction take place that was multiple $1 billion in size, and we believe that multiple applies to their business that might trade for 100 or 200 million. And the reality is that market rewards scale, and they also punish lack of scale. There needs to be some adjustment for the size of the situation that's being evaluated. Now, the smaller business may have a substantially higher growth rate and potential than the larger business. That actually might justify the multiple that's being paid. But we look at a variety of factors, and as I mentioned, it's an art as much as it's a science. And ultimately,
Gotcha. And then do you like to put a multiple on earnings or do you put a multiple on revenue? Both.
Usually we're looking at multiple ranks, and for technology area businesses, the revenue multiple is more applicable early in the life of the business because are those significant investments in the sales and marketing organization as you ramp that later on will turn into earnings. So we look at the situation and adjust appropriately and use our methodologies for the relevant situation.
Understood. And then just so I understand the range of businesses, or if there's any founders out there in the spaces that you've mentioned, what is the smallest and then largest deal, size companies you look for, approximately?
Speaking in terms of, yeah, speaking in terms of enterprise value, it's really 50 to 250 million in terms of enterprise value. What does that mean from a practical application? 10 million plus of revenue and 3 million plus of EBITDA. So 3 to 25 million EBITDA is our range in terms of investing.
Okay, fantastic. Well, is there anything I didn't ask that you'd like to mention before we wrap up here, Sean?
No, I think that we're in an interesting time in the world of a lot of uncertainty. You're seeing all here push more money from the public markets into private equity and other alternatives, and it's becoming a bigger part of the overall economy. And demographic trends that support that with the baby boomers looking to retire and transition their businesses with oftentimes no member guarantees and also a lot of their net worth tied up in the business. So private equity has been very relevant over the last several decades and will become even more so in the coming years.
Yeah, I fully agree. For a long time, I never really dove into the private equity world on a personal level, but just recently, in the last few years, I started to learn more about it. Maybe the last 7 to 10 years or so, since the '08 recession, because there were a lot of good deals that came out of there. And I looked at businesses, and I started to buy personally, and I realized I was like, wow, there's a lot of interesting value that can be created, and you help the founders because these founders they're not so much business people; they're more just operators and tend to be by secondary. They run their business, but their primary goal is their craft, whatever their craft may be. So they don't know how to set up a board. They don't know how to put that institutional structure in place. And yeah, I agree. There's a tremendous amount of value that private equity brings to the table when it's done right.
And you get a lot of situations where the federal work really hard earlier in their life, maybe not where the business is generating 5, 7 million a year, and their goal isn't to take it from 5 or 7 to 10.
Right.
It's I think I'm going to vacation next year.
Exactly.
Or how do I start protecting my downside and make sure that I don't lose this?
Exactly.
And for us, we come in and that's our opportunity to help them change the risk profile when they achieve those objectives. So personally, but also maximize the potential of the business.
So I just had another question pop in my mind before we wrap up, Sean. What do you find most founders tend to do after you buy? So after you guys make a deal, you've got majority. Do they stay on board for the entire process until you sell to another firm or until you grow it, or do they end up leaving?
Most of the time, I stay on board as an investor. Usually, as a member of the board of directors, they know so much about the business. They have the full history. You want to keep that around the table, obviously. Continue to have a material stake in the business, so they want to have part of the oversight. And then it depends on whether or not they're maybe a member of the management team where they are in their life and their role. A lot of times for us, they do. It's just they want to have the team built around them and they want to play a specific role. For example, they want to be the chief technology officer. They don't want to be the CEO.
Understood.
So what we need is we just need them to be honest about what their goals are, and we can build around that. And as long as we have the right timeline, where it doesn't work is when somebody says they want A, but they really want B,
Or
and they're just not transparent around it.
or C or D or E. All right, great. Well, Sean, what's the best way for people to get in touch with you?
Best way by email. Our website is elfsbergcap.com, and my email address is sberett@elfsbergcap.com.
Beautiful. Well, thank you kindly for coming on the show, and we'll talk to you soon.